Hello, this is Rajesh here with my YouTube channel Rajenomics. In my previous lecture, I talked about repo rate, which is an important tool of monetary policy. Now I'm continuing that lecture in my part 2 of monetary policy, and I'm going to talk about two more tools of monetary policy: reverse repo rate and cash reserve ratio. Before that, a quick recap of repo rate. I mentioned that repo rate is the rate at which commercial banks borrow from RBI for their short-term needs. This repo rate is increased or decreased based upon what is called as BPS. BPS stands for basis points. One basis point is 1/100th of a percentage point. So every quarter repo rate is examined and then it is decided by the Monetary Policy Committee of RBI whether it should be reduced or it should be increased or a status quo should be maintained. Of course, as I mentioned in my previous lecture, it all depends upon whether a contractionary monetary policy is to be followed or an expansionary monetary policy is to be followed. Now, continuing with that, the another very important tool is reverse repo rate. Reverse repo rate is the rate at which RBI borrows from commercial banks. This is done to absorb excess liquidity that commercial banks may have. RBI offers a higher interest rate to commercial banks to keep some amount with RBI. So the rate at which this is done is reverse repo rate, the rate at which RBI borrows from commercial banks. So during the time when price stability needs to be achieved, that is when inflation is there in the economy, RBI increases the reverse repo rate, which attracts the commercial banks to keep their funds with RBI in order to earn higher interest rates. Once again, I will repeat that during a time when price stability is the goal, that is, inflation is existing in the economy, RBI increases the reverse repo rate, which attracts the commercial banks to keep funds with RBI. As a result, there will be less liquidity with the commercial banks, which in turn will take us to the goal of price stability. That is what is expected. Then the next tool is cash reserve ratio, CRR. Cash reserve ratio. Out of the total time and demand deposits which commercial banks have with them, out of the total time and demand deposits which commercial banks have with them, a part of it is kept with RBI. That part is known as cash reserve ratio, and this part is not to be given as loan to businesses or to consumers, or it is not meant for investment purpose. So this is not to be touched by the commercial banks. This will be kept with RBI. Here again, the logic is same. If it is a contractionary monetary policy to be followed, that is when RBI wants to contract the money supply in the economy in order to achieve the goal of price stability, the cash reserve ratio is increased, which means more will be kept with RBI. More with RBI, less with the commercial banks. So less liquidity, less money supply, and we hope to achieve the goal of price stability. On the other hand, when it is expansionary monetary policy to be followed, that is to give a push to the economy, RBI reduces the cash reserve ratio. Reducing the cash reserve ratio would mean commercial banks would keep less with RBI and they have more liquidity with them, which they can give it as loan to businesses, to consumers, which is likely to help with the growth of the economy. So reverse repo rate and cash reserve ratio are another two important monetary policy tools along with the repo rate. I hope this makes some of the monetary policy tools clear to you. Thanks a lot. Please like, share and subscribe. Thanks a lot.